Measurement Fundamentals continued. Before we turn to doing some examples of these concepts and measurement fundamentals that we've been looking at, I want to stress one more time that there are many subjective judgments as we use and apply these measurement fundamentals. In other words, there's many shades of gray. And because of that subjectivity in the valuation, whether we use input or output market values to value our assets, liabilities, revenue, or expense, and shareholders' equity too, when we look at our financial statements and we measure how much does it cost, we know that how much does it cost can differ depending upon whether I'm looking at land or a long-term investment, which is at its original or historic cost, inventory, which is valued at the lower of the cost or its market value, its replacement value. The net realizable value, how much cash do you really believe you're going to receive from those pesky customers that you sold to on credit. What the book value, in other words, remaining value is of the property, plant, and equipment or intangibles after you've subjectively come up with how much depreciation or usage of that property, plant, and equipment has already happened, or for intangibles, it's the amortization expense, which is used to value or spread the cost of those intangibles out over their useful lives. We know that cash is pretty easily to get as far as its face value, but exactly coming to the penny of how much cash you have can be an onerous task, because I don't know about you, but there's pennies, nickels, and dimes that tend to be on the floor, in the wash, and all over the place. So it's hard to get to the penny precision as to how much cash there is. Current liabilities, yes, they're valued at their face because we've received those bills. Or we anticipate receiving some of those bills. And the fair market value, we know, is used for short-term investments, and we need to make some assumptions about the cost of money and the implicit interest rates to come up with what is the present value of a long-term note, whether it's a long-term note receivable or a long-term note payable. So what it comes down to is really, when we look at it, that we are subject to judgment. And that judgment is judgment by managers, accountants, and auditors. When they apply those accounting concepts, things like the matching principle, coming up with accruals and deferrals, making their assumptions about economic entity, fiscal period, going concern, stable dollar, applying the measurement principles of objectivity, revenue recognition, matching, and full disclosure, thinking about constraints such as materiality and conservatism, which we'll talk about in a little bit. So all of these applications means that we are reliant upon people, and we are hoping, bottom line, is these people have integrity and are really thinking about the information needs that a user would have and supplying that information so that it's useful and that it is free from bias and honest. So that's the bottom line that I want you to remember, that all of the accounting that we've talked about and all the concepts were created and evolved because human beings needed a way to account for their business and to convert business transactions into numbers so that judgments could be informed by meaningful data.